I'm actually going to show you exactly how I got a 67% return on this investment, a 66% return on this investment, and a whopping 88% return on this investment. Today, I'm sharing practical tips that you can apply today in your own research. All I ask, tap that like button down below. Tip number one, we gotta do ninja research. See, research isn't just looking at a price and seeing if it went up or went down. You have to do a little bit more of a ninja trick with your research. Here's how I do it. One could easily say, oh, wow, look at this price action on this particular stock. It's a BlackBerry stock. It's up, it's really cheap at only $2 a share. I could buy a ton of shares with my money, and then if the price goes up, I'm going to magnify my gains. But if you want that 50 to 90% return that I showed earlier, it's actually not how you do it. In fact, if you look at BlackBerry, it has issues. The 5-year and the 10-year show absolutely terrible losses. And if you look deeper into the stock, you'll see the company isn't doing well financially. And this is where the ninja comes in to look deeper into any stock or any ETF before you buy. See, what you want to do, go over to something like Seeking Alpha. It's one of my favorite. I use the premium version so that I can look deep into all the different financial reports on any stock that I'm interested in. And by the way, you can grab a discount using the link below if you want to follow along. So the very first thing I do is look at each company as a company that I'm going to buy and own for a long time. I don't want to buy the stock short term. I don't want to day trade the stocks. Otherwise, I could be missing out on seeing the gains that I shared with you earlier. So first, what we want to do, how are their financials looking? I'm digging into things like number one, is their revenue going up year over year? Number two, is their profit positive and going up year over year? Is their EBITDA going up? By the way, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. But is that going up? And number four, do they have a good balance sheet where their assets are higher than their liabilities? Or are they massively in debt and just one small setback away from bankruptcy? Number five, is their levered free cash flow growing or falling? Number six, how is their PE ratio compared to their competitors? Now, as I'm researching, if these things check out and they're positive, I may actually consider buying the stock. Even if the price is high, the idea is that they're going to continue to keep growing or maybe paying more dividends over the years ahead. That's what we're looking for. Now, if you want the full ninja research, I have a full dedicated video on how I pick my stocks that you can check out to dive a little bit deeper. I'll link it down below. Remember that when you buy a company, you want to stay on top of that company. Even if the financials look great today, you want to do a health check, maybe every 3 months, every quarter, to ensure that that stock is still doing well based on your expectations. If the company starts making bad decisions, their financials maybe start getting scary and issues are starting to pop up, you might want to have a decision to maybe sell the stock or fully understand what the recovery plan is if they are doing worse so that you can make the best move. The absolute worst thing to do is hold on to a stock, just like the Titanic, and go down with the ship. I actually learned this myself. Here's a problem I had. I bought Circuit City back when I was young, dumb, and stupid. I held on to that stock even though the company was headed for bankruptcy. I wasn't looking at the financials. But that stock helped me become a better researcher and a better investor today. Let me reveal one of my top performers here under tip number one, which is actually Delta Airlines, ticker symbol DAL, which has returned 66% in my portfolio. Now, I originally bought Delta when the market crashed in 2020 and travel was impacted. The stock price dropped from right around, I think it was $54 a share down to $24 a share, and I started buying. And I still buy DAL today, even though I'm not as aggressively buying it as I was back in 2020. And here was my thesis. I did my ninja research on Delta, where I looked at their financials and I realized, hey, this company is doing well. It's strong. This setback is a global issue that we're having. And for sure, I think someday people are going to return to travel. So I bought and held with that thesis. And today, that's why I'm up so much, because obviously they're financially recovering back to pre-2020 levels. And I think they actually still have more room to grow for their financials in the future. So I'll keep checking quarterly to ensure that my thesis remain strong. And if it doesn't, if Delta starts doing something weird, if the financials go down, I may decide to sell. But that's not financial advice to you to buy, hold, or sell any investment that I reveal today. So the 66% return is because I bought when everyone else was freaking out, they were selling. And, I gotta say, I love buying good, solid companies when things are scary. When a stock drops, you have to apply ninja research. If we look at something else like GameStop or AMC, which is up high and also down low based on short squeezes and Reddit. And you'll see the fundamentals of the company when you do the ninja research. It's just not strong for either one of those. So it makes more for a gamble than a well-researched stock. So tip number 2, we want to diversify our portfolio. I don't go all in on just Delta, and neither should you. We want to diversify our portfolio so that if something stupid happens with one of the stocks or one of the sectors or one of the companies, we are protected from a massive downside on our portfolio, especially as we grow our portfolio well above and beyond $1 million, because that will hurt even more. So for example, diversifying over stocks, bonds, real estate, dividend paying companies, and more are very important to consider. You also want to look at sectors. If you buy only Apple, Google, Tesla, you're really technology heavy. So what happens if the technology sector starts having an issue? Down you go with that diversification hedge. So maybe throw in some other sectors like, financials, consumer discretionary, and things like that. And if you'd rather not have to deal with all of that for individual stocks, this is where ETFs come in play, and they can be very, very helpful. ETFs hold hundreds, sometimes even thousands of stocks, and can help you automatically diversify and adjust your holdings based on how things are going with those individual companies and the overall stock market. And honestly, this is where over 80% of my portfolio lives, in ETFs. I like things like the total stock market ETF, such as VTI, or if you want S&P 500 exposure, something like VOO. Now, one ETF that I focused on that is aiming for blue chip companies is Vanguard's Mega Cap ETF, MGC. I've been investing in this since 2018 with small amounts here and there. This particular ETF has actually grown by over 67% so far. But see, here's the thing. It wasn't always looking positive. Even though I focused on diversification and research, this ETF was actually negative at one point, which leads me to tip number 3. You gotta stay patient. So look at this screenshot from a small $5 purchase I made on May 27th, 2018. The share price at the time was $93.18. But if we jump over here on Seeking Alpha, MGC then dropped from $93.18 when I purchased in May to $84.02 on December 17th, 2018. That means I lost money. I was down on my portfolio. Well, on paper, I lost money. I didn't actually sell. So I decided to keep on investing every week, and because I had a good thesis, did my research. But I'll be honest, seeing a negative balance could have freaked me out and had me selling and cutting my losses. But trust me, I thought about doing that a couple times. But then MGC rises up to the top, and it looks great in February 2020 until the market drops in March 2020, where we went back to $81.38 a share. It went negative again. But see how patience paid off, a 66% return today. Honestly, it's not hard to want to cut our losses when our portfolio is down, but the richest people in the world, they hold and hold as long as tip number 1 stays intact. And then there's tip number 4. Invest in growth stocks. If you have a good time horizon ahead of you and you have patience for years for your portfolio growth stocks can really deliver significant returns over time. And by the way, growth stocks do not always mean technology stocks. So right now, technology is the strong suite of investing. But this can change over time. And I could easily, honestly see AI replace the basic technology that we enjoy today for the next growth factor. But remember, years ago, oil was the big growth factor. So the point is to focus your portfolio investing on growth stocks over low return stocks. And go ahead and queue up my 88% return This one was Google. So I had started investing in Google in 2021 when it was really actually a dumb time to invest in Google when you look at it from a price-only perspective. So the reason I say that is the price at the time was at an all-time high for Google, and it continued to grow, but I continued to invest because I had a good thesis. But because I was focused on the growth stock and I kept my eye on the financials with tip number one the entire time, I felt good about Google's future growth. And then of course, to date, it paid off and I'm up nicely in the portfolio with plans to continue to invest. And one final diversified yet growth-focused investment that I have is QQQM. This fund focuses on the NASDAQ 100. It's the top 100 non-financial companies listed in the NASDAQ index. And they include powerhouse growth funds like Google, like Tesla, Apple, Microsoft, Nvidia, and so much more. Now, I only started investing in QQQM in early 2023, but I'm already up 28% on this fund. And the future growth of this ETF makes me really excited about the future, even if we have a little bit of a pullback. So 40, 50, 90% returns. They are possible, but not for the weak. But you're not weak. You're strong. You're worth it. And you're ready to take your portfolio to the next level by watching this video next, and we'll see you on the next video.